Hi there, Rich. Thanks for taking time today. We're going to talk a little bit about spin-offs, and you specialize in spin-offs. As a matter of fact, that's pretty well all you do, but it seems to have been successful. So, over the past several years, we've watched numerous companies, whether they're large cap or medium cap or small cap, and mainly on say U.S. stock exchanges, although internationally as well. So say in 2019, we saw Fox Corp created from 21st Century Fox. We saw DuPont spinning off into two separate companies, Dow Chemical, of course, and Corteva. And also that last year we saw pharmaceutical Novartis spin off Alcon. So and we know that a large number of the large activist investors really lobby for this, so I guess it's advantageous for them. But what about for individual investors? Or what's the benefit for them?
Yeah, well, first of all, Ernest, thanks for having me on. This is great to connect. Yeah, so in terms of the benefit, I mean, at a high level, Wall Street prefers simplicity. So it's much easier for Wall Street and professional investors, and for that matter, individual investors, to evaluate a company that's focused on just one vertical or one sector. And so the benefit for the company, for Wall Street, and for individual investors is oftentimes when a company, a division is a part of a larger, conglomerate, it's kind of lost in the weeds. There's not much focus on it. Even if it's a really high growth, really profitable, really nice division, oftentimes it's hard to actually value that appropriately. And so the benefit of spinning off some of these divisions is just to basically shine a light on the division. In the case of Alcon, this is a great company that's focused primarily on the ophthalmic market as well as on contacts. And it's a market that isn't particularly economically sensitive. It is, there's going to be, demand. You're going to need new contacts, even if we enter a recession, which it looks like we're at the beginning of a recession. And so, when Novartis was able to spin off Alcon, it traded at a really attractive valuation, a really high valuation, and deservedly so. It's a great business. And so, from that perspective, it makes a lot of sense to separate these businesses that are very attractive and would possibly trade at higher valuations on their own. And it basically gives, individual investors and institutional investors the opportunity to own those, to continue to own that spinoff or buy more. But it gives them a better way to really know what they're buying. They're not owning just a conglomerate of a bunch of different divisions, but they're owning more often than not, in the case of spinoffs, a pure play in one different division.
Now, it seems that last year at least, I'm not sure about 2020 so far, but for 2019, the performance between the spinoff index and also your recommendations has been very noticeable compared to the S&P 500. How do you explain that major difference that you see?
Yeah, so it's funny. If you look over the past, call it, 15, 20 years, spinoffs as a, asset class, I know they're not an asset class, but they've generally done really well. And you can just Google stock spinoff performance. Joel Greenblatt wrote a book called You Can Be a Stock Market Genius, which really talks about the excess returns. And there are a bunch of academic studies that show that spinoffs really typically outperform. In 2019, there were definitely certain spinoffs. Pennant Group is a spinoff. It focuses on the home health and senior living market, which performed incredibly well. Contour Brands was another name that although it initially dipped, performed really well as well. But overall, the spinoffs actually underperformed the market in 2019, even though over the much longer time period they've outperformed. And the reason why I think that's the case is first of all, a lot of times spinoffs tend to be a lot smaller. And in the most recent, market, the S&P, which is made up of, a lot of the FANG stocks like Facebook, Google, Apple, Netflix, those big stocks have really been driving the market higher, and a lot of the lower, smaller market cap stocks haven't been performing as well. So I think that's part of the reason why spinoffs in the past year haven't performed quite as well. But if you look over the long period, I'm talking 10, 15, 20 years, spinoffs have, outperformed handily. Bloomberg tracks the spinoffs. So they track the spinoffs in the US. And last time I looked at that index, it's returned 15% per year going back to inception, which is right around 2000, outperforming the S&P 500 by about 200 to 300 basis points. And I think the reason why spinoffs outperform is a couple-fold. First of all, spinoffs tend to be smaller, kind of a smaller subdivision of a larger conglomerate. And oftentimes there's not much or any analyst coverage initially. And oftentimes a conglomerate will distribute to its shareholders shares of a spinoff, and that spinoff will represent maybe 5 or 10% of the total value of your holdings of the parent company. And it's almost a rounding error. So oftentimes you as an individual investor will just hit sell. You'll just say, hey, what is this new company? I didn't buy it. I view it as kind of maybe a dividend, and I'll just sell this and take my gains and continue to own the parent company. Well, because there's a lot of selling pressure from individual investors, but also institutions. So for instance, say you're a large cap value portfolio manager and you own, a large conglomerate, and you receive shares in a small cap spinoff from that conglomerate, your investment mandate prohibits you oftentimes from owning small cap stocks. So you're basically forced to sell. And so there's a lot of selling pressure that spinoffs experience right after they start initially trading. And so that's the reason why spinoffs start trading at low valuations. And then historically, entrepreneurial forces are unleashed. And that's a quote that Joel Greenblatt says in his book, You Can Be a Stock Market Genius. And what that means is previously the spinoff used to be a subsidiary of a large corporate conglomerate, where every decision, whether it's CapEx or marketing spend, had to be approved by 2 or 3 layers of management before the business, the person who ran the business could actually make the decision. When the spinoff is set up on its own, management has stock options that incentivize them to make decisions that will improve the long run prospects for the business, but they also don't have to clear or fight for resources versus other divisions that may be faster growing within the conglomerate. So oftentimes, employees and management of a new spinoff is incentivized and are really motivated to, it's kind of like a startup that's actually has solid financials. And again, they have stock options, they own stock in the spinoff. And so they're really incentivized to do their best to increase value over time. And then historically, what you see, spinoffs start trading at a low valuation. Operations tend to improve over time, and then valuations expand over time. So JP Morgan did a study that looked at the initial valuation of a spinoff versus its valuation 2 years out. And what they found was that the typical valuation, or the average valuation, is about 6.5 times EBITDA. And then if you look out 2 years, it expands to 8.5 times EBITDA. And the reason why it typically expands is, one, you have improved operations, but two, you have greater greater knowledge of the spinoff. It takes time for the spinoff to get on people's radars, to show up in investment screens, to be added to certain small cap indexes. And so over time, additional maybe sell-side analysts will pick up coverage of the spinoff, and all that helps to basically increase the visibility of the spinoff and increase the valuation. So that's really the reason why spinoffs historically have been a really good place to invest.
Well, speaking of conglomerates who swallow companies, what's the how wise have some of those decisions been, considering the number of spinoffs and divestitures that have been taking place? For instance, if you look at GE, they're going to be shedding themselves and have shed themselves of several of their major divisions. and several other companies have done that as well. Can you have 20/20 hindsight by saying, well, maybe those companies, those divisions shouldn't have been added in the first place?
Yeah, so I think, I mean, if you look at the academic literature, so it's basically the opposite of spinoffs, right? So generally, mergers and acquisitions underperform what the manager's original estimation was. And so usually, you know, a management team is excited about a potential acquisition because it will give him or her a chance to manage a business that's twice the size in terms of revenue, the size of the previous business. And that's, you know, that allows management to puff their chest out and say, you know, I manage a, you know, a Fortune 100 company or an S&P 100 company. And they also tend to dream up grandeur plans of synergies, and, you know, we're going to combine these divisions, and it's going to allow us to accelerate revenue growth. And also, meanwhile, we're going to be able to cut costs. And more oftentimes than not, you know, about 90% of the time, acquisitions fail to generate the returns that the original management team, you know, thought it would. And then oftentimes you'll see that division be spun out. So Alcon is a perfect example, right? So Novartis was all excited about Alcon because it was this big growing market, big growing company focused on contact lens and the ophthalmic surgery market, which was growing and very defensive. And so they thought it would be accretive to buy Alcon and bring it within the Novartis fold. Well, they brought Alcon in, and no sooner had they brought Alcon in when expectations or Alcon as an individual division within the company started, you know, to miss its internal plans. Revenue growth slowed a little bit. It was hampered by the bureaucracy of the larger Novartis organization. And so Novartis, they got a new CEO in, and sure enough, the CEO said, okay, let's spin out Alcon because it's going to trade at a higher valuation than it would as a part of Novartis. So it's this game, right, where bankers go around. I mean, they get paid to pitch acquisition targets, and, you know, to estimate synergies and how much value could be created. And of course, Novartis had to pay a premium to be able to acquire Alcon, to get a control premium, but then they distribute Alcon to their shareholders without the control premium, and basically reversing everything that they had done, all that brain damage that they had done over the years. And there are several examples of situations like that. But you're exactly on point. I mean, M&A is a perfect example. When it's done well, it can be really a great source of value creation, and Berkshire Hathaway is a great acquirer. A lot of private equity companies are good acquirers because they're focused on the bottom line. But more often than not, unfortunately, acquisitions tend to disappoint, and that sometimes those acquisitions are just completely unwound as the company that was acquired with a control premium is eventually spun back out.
Okay, a couple of final questions here, Rich. First of all, any types of potential, other than the ones that we listened to or have just spoken about, any other potential spinoffs that maybe investors should be looking at? And also, what kind of advice would you give to the individual investor who might be considering looking at some of the spinoffs and divestitures?
Yeah, so in terms of some spinoffs that I think are interesting, I mean, you know, if we had had this conversation 2 or 3 weeks ago, it would be a completely different list. But as you know, the market has sold off incredibly. So there are some really compelling deals out there. So Fox Corp is a company that you mentioned previously. You know, previously about 3 weeks ago, they reported a great quarter. The stock was up. The stock's down about 40 to 50% from those levels. It's now trading at about 7 times free cash flow. It's a business that has very high margins and generates a ton of cash flow. And due to how the transaction was struck, where they sold 21st Century Fox to Disney, they basically acquired these tax assets, which is going to enable them not to pay taxes for the foreseeable future. So Fox, I think, is definitely a very solid company that the viewers of this video could check out. There's going to be, they get the majority of their revenue from Fox News, which, whatever your political view is, it's an incredibly valuable, profitable enterprise. And then they also generate about 20% of their revenue from live sports, which perhaps is part of the reason why the stock has sold off, because many of the professional sports in the US are temporarily paused due to the outbreak of coronavirus. But I think that is going to be, a temporary situation. And you get a chance to really buy, a premier company at a very, very attractive valuation, and they're buying back stock. So that's nice as well. Contour Brands is another company that I like a lot. This is a spin-off that previously had performed incredibly well. They're focused on manufacturing jeans. So the Wrangler and the Lee brands are their key brands. The stock has traded off a ton, but what investors don't really appreciate is it's a very defensive business. Revenue only declined by 10% during the great financial crisis, so it's a more defensive business that you would expect. They generate a ton of free cash flow, and they're paying over an 8% dividend right now. So pretty remarkable there. And then let's see, in terms of advice for investors. So I would say check out my website, stockspinoffinvesting.com. So I publish a stock spinoff calendar, which will let you know the upcoming spinoffs as well as the past spinoffs. And so you can view that calendar to get an idea of which names you might want to dig into a little bit deeper. I'd also say read a book called You Can Be a Stock Market Genius by Joel Greenblatt. That's a book that I've mentioned already, but it's a great book. There's about a 60-page chapter that just talks about the reasons why spinoffs are interesting and where to look. And then I would just say to dig in, to follow some spinoffs. Don't invest all your money in spinoffs, but maybe carve out a little portion of your capital that you want to invest in this niche, and dig in. Start doing some work. Do some fundamental work like you would any other stock. Does the company's products, is there a good outlook for the company's products? Does the company have, a reasonable balance sheet? Does it have too much debt? All the questions that you would ask when evaluating a typical company. Just ask those questions and dig in. I think the best way to learn how to invest in spinoffs is just to dive in and start experiencing it.
Okay, Rich, thank you very much for the advice. It's been good talking to you. One final thing, if any viewers would like to contact you directly, how should they do that?
Yeah, feel free to shoot me an email at rich@stockspinoffinvesting.com, and I'd be happy to speak with anybody.
Okay, thanks again, Rich.
Thanks so much. Really appreciate it.